Hello and welcome to the Premium Account Market Update for October 2016. Any individual reading or listening should discuss with their financial planner or advisor the merits of any recommendation offer presented in this material for their own specific circumstances and realise that not all investments are appropriate for every individual. Presenter today, myself, Leon Hine, Managing Director of Investor Signals, have over 18 years of experience in the financial services industry and a current licensed securities and derivatives advisor. The format for today, we look at the global macro update driving equities. We roll through the top 50 with a particular focus on FY 17, FY 18 earnings, and we combine that with the technical trends in the charts, our portfolio allocation, and conclude with a short-term market outlook. The Investor Signals service is based around a model portfolio of ASX 50 stocks. We use call options to enhance returns. Importantly, the assets remain in your name, and it's all in a strict investment mandate, therefore suitable for self-managed super funds. If you'd like to know more about the service, please contact me on the 02 number or email leon@investorsignals.com. Moving straight into the first graph that I want to look at, which is the Dow Jones. Now, we're in the early stages of US earnings, and assuming that S&P 500 companies deliver roughly between $30 to $32 of earnings for the September quarter, which I think is very achievable, and I think there's a high probability that as a minimum the earnings meet or slightly exceed expectations. So I actually don't see a great deal of risk to equities from where we sit at the moment. Appreciating that obviously there's some volatility at a macro level around US elections and concerns around the rate that bond yields are going to rise, but I'll get to that in a moment. So from the charts, what we really want to keep an eye on is, can the US equity market build support on the old resistance? And so just to sort of revisit that, when you consider that it's pretty much the US equities have not gone anywhere as an index, or at least at the Dow Jones, and the S&P 500 is not too dissimilar. They're probably Nasdaq's outperformed a little. But since the end of 2014 or the very beginning of 2015, the Dow's been bumping up against this 18,000 resistance level. For the first time, we've seen the market break through that post this Brexit rally that the market's enjoyed, and now what we've done is seen the market pull back to sort of sit roughly on that old resistance level. So I think we're in the early stages of the market testing those technical levels, and the September earnings results as they come through may be enough to start to drive US equities off that level. The domestic market I see a little bit different, but again, I'll get to that after we look at sort of one of the key focuses for equity markets at the moment, which is the yields in the US. So this is a graph of the 10-year treasuries, and we've seen the yields rise from about 1.3% up to 1.7678. Now, it wasn't that long ago that yields were sitting at around 2%. That was sort of early in 2016. And then with the weaker data coming through from China and the Brexit issues, we saw those yields gradually sort of move lower. I guess the concern that the market has is, at what trajectory does US rates increase? And it wasn't that long ago either that there was some concern that the US may follow Europe or Japan and actually have to move towards negative rates, look at further quantitative easing or asset buying programs. Now, right at the moment, the market's consensus is that we're moving into a rate rise in December. So those prior concerns are probably off the table a little. But, you know, I guess we just need to keep an open mind. As I roll through the top 50 stocks, though, the technical patterns are probably telling us that the rate rise will occur in December, and the yield names will remain under pressure, and that's a key theme to be aware of when managing your portfolio. So we'll continue to revisit these bond yields, especially coming into that December rate rise. Looking at the XJO, now again, taking the backdrop there for the Dow Jones where it's sitting on top of support being the old resistance, the XJO's created higher highs and higher lows, which has been encouraging. I've spoke about that in previous recordings, that after 12 months of a downtrend, predominantly driven by underperforming banks and resources. We've now seen the index reverse and create these higher high and higher low patterns. Just as we see that as a positive for ongoing support for the market, I've labelled these levels 1, 2, and 3, and simply if the index starts to break back down below those levels, I think from a portfolio protection standpoint, derivatives that buying put options or buying protection or using inverse exchange traded funds to make money when the market's falling become key issues for investors to think about. I'd be reasonably concerned about the structure of the Australian equity market if we started to move back down through even this first level, but certainly through this second level, because I think what that then creates as a concern is the structure where we've had this sell-off, a 50% bounce, the market's failed to move on with it, and then if it starts taking out these levels on the downside, I think a plan needs to be put in place. But that's not my base case. My assumption is in line with the comments on the Dow Jones that global equities hold above sort of this support level driven by S&P 500 earnings meeting or slightly exceeding expectations, and that should create the foundation for the XJO to consolidate, move sideways, and then maybe we get in past the December rate rise and the election in the US, and equities can maybe start to build a base and move a little bit higher. On that note, let's move straight into the top 50 stocks, and I'll move through these fairly quickly. So the AGL, I have them now trading on roughly a 4% dividend yield, just below that. So on those numbers, with underlying earnings growth of around about 7%, 5 to 7%, I think AGL's fair value here. Our strategy really has been to sell covered calls up at around $20. We think it's moving sideways. Combination of the dividend and the call option, you're delivering close to 10% cash flow. Amcor, I think this has had a little bit of upside, and I've spoken about this in previous recordings and on the blog. It's a buy on the dip here at $15. The stock is a little expensive, trading 19 times earnings on a 3.75% dividend yield, but I think we can see earnings growth return in the magnitude of 7 to 8% per annum for Amcor. So if we go out another 12, 24 months, arguably Amcor could be trading up at around $17.50. So I think that's a good one for portfolios. Let it rally a little and then sell the covered calls. AMP, other than to say this has been on the radar, but if you followed my previous recordings, you would be aware that I've not been keen on AMP. Our preference has been to have exposure to the other banking stocks or other financial services plays over AMP. Now, a lot of analysts are very bullish on AMP. Price targets up around $6.50 with underlying earnings growth re-accelerating. But in the latest result, there was no earnings growth. The stock's on a 5.5% dividend yield. I think it's interesting. Structurally, it's in a broad uptrend. It's had a bit of a sell-off, but right at the moment, it just seems unclear to me as to whether it's going to hold this support. But we're keeping an eye on it at the moment. All you can say is the technical structure is fairly flat in the context of sort of equal highs and equal lows. But the stock seems to be languishing down at this sort of lower end of that channel. So I think in some respects it's underperforming other areas of the market, which is often a little bit of a concern. ANZ, the market's favoured ANZ on the basis that they're restructuring their business, stripping out costs, and better managing their push into Asia. And we've seen ANZ rally off the back of that. I now have it trading on about a 5.5% dividend yield. If you look across all the Australian major four banks and even the regional results, there's really limited earnings growth. And therefore, it really just becomes a story of can the banks manage their costs, do funding costs increase, as well as obviously just general operational costs. And I think we're in an environment where the Australian banks move sideways. With the exception of ANZ, which has actually broken out into a higher high. And you can see here that my view is let's revisit ANZ. Should we see a bit of a pullback into this 26.50 range, then we have a higher low structure. And that's the first time that we would have seen a higher low structure in any of the four majors for quite some time. So we'll have a look at that as a theme as we roll through the top 50. APA, so in line with all the utility and defensive yield names, we've seen APA sell off back down to $8. Not really something on our radar at the moment, but I have it trading at about a 5.5% yield. Now, ASX, it's a great business, 100% fully franked dividend yield, had been growing earnings at around 5% per annum. There is a chance that there may be a takeover at some point, maybe Singapore or Hong Kong Stock Exchange. Look at the ASX. We're seeing consolidation among the exchanges worldwide, so I don't think that ASX is going to get left out of that over the coming years. But the stock's expensive at 21 times earnings, just over a 4% dividend yield, but I do think it's a buy, especially if we've seen it sort of move down to this $45 level. But even at sort of where it's trading at the moment, I think it's attractive. But I will flag that the most recent volume data that the ASX updated, so trading volume data for, I think, July, August that I looked at, probably doesn't support earnings exceeding market expectations. So I'd have to say over the next 6 months, barring a takeover offer, I think ASX really moves sideways, and sort of 45 becomes support and sort of 50 odd becomes resistance. So it's one of those stocks that I'd complement with a covered call to enhance the returns. AZJ, I think this is setting up for another shorting opportunity up at around $4.90. I think the stock's getting expensive. I still maintain that we'll see the company cut dividends in the next 12 months, which will weigh on the share price. BHP, my view on this is around 22.50 is about fair value. We've seen it sort of reach sort of 23.50 in the last few days. Factoring spot prices on BHP and Rio, arguably the stocks are worth a little bit more than where they're trading at the moment, or at least spot prices support an uptick in earnings, and therefore the valuation that we have. So again, allowing for spot prices, upgrades to earnings, upgrade to dividends. I have BHP and Rio roughly on a 3% dividend yield on a forward basis. Now that's going to require upgrades to the most recent payout ratio, or of not so much the ratio, but from an earnings perspective, percentage of the earnings. So again, my base case, BHP tracks sideways around this 22.50 level. Don't see it doing too much more than that. Brambles, I like this name. I think it's expensive, 22 times earnings on just on a 3% dividend yield. So I think own it, sell covered calls. You can see there that I see it moving sideways within that channel. Commonwealth Bank, so let's look at this technical structure. So ANZ was a little bit different, but certainly here in CBA we see lower lows and lower highs. I think the return on equity starting to slip a little in CBA, and it certainly trades at a high premium, about 5.5% dividend yield. I don't think, again, bringing this back to the context of the view on the overall markets, both in the US and Australia, if I'm having a view that the indices are going to be stable and largely track sideways, then it's hard to build a case that CBAs are short from these levels. I just think it's hard, in line with nearly all of the market. Most opportunities that we look at, I think, only really start to make sense when you add the covered call option in to enhance the returns. Coca-Cola got a little expensive. It's pulling back, I think, around $9.50 as fair value, puts the stock on about 18 times earnings and about a 4.7% dividend yield. I'd expect it to find support, and again, it's broken out of this down structure here and created a higher high, so it comes back onto our radar as a buy on the dip opportunity. Computershare, I think this looks expensive. We've seen the company miss on the earnings front, albeit the most recent result in August was a little bit better than those over the last, say, 18 months. But I still think up here at sort of 3% dividend yield, possibly nothing in the way of earnings growth, Computershare starts to look a little bit expensive. I think the range is sort of back down around, maybe not back down to $9, but say $9.50 up to around $11. Look for it to consolidate. If it breaks out above that, then we sort of change our view and it comes back onto the radar as a potential buying opportunity. CSL, I thought that the AGM was encouraging. I thought the growth in all their product sales was up substantially. I think the growth rate that they're achieving in China was 2 or 3 times better than what they're achieving in other established markets. And I think CSL, whilst the technical structure looks negative at the moment, I think the stock can probably rally back up to this resistance here around $115. Now, we own it from lower levels back here earlier in the year, and we've sold the $110 calls into December. We got good premium for those, roughly around $4 to $5. So we're achieving an effective exit price of 115 on CSL if it finishes the year around 110, and I think that's achievable. I think sort of the range is 100 back up to 115 for CSL. To put some numbers on that, it trades at around 25 times forward earnings on approaching about a 1.7% dividend yield. Caltex, this is one that we've liked. I've commented on this a number of times. They're making a tilt for the portfolio of Caltex stores that Woolworths owns. But in general, the underlying business, about 5% earnings growth, trading on about a 4.5% dividend yield. We own it at lower levels. We've sold the covered calls over this, and it's sort of doing everything that we'd expect it to do, and it's adding good cash flow to portfolios from the dividend and the call option income. Goodman Group within the property trust, sort of this is one of the few names that has had a sell-off but yet still has a bullish structure in place. So it's found support sort of at this old resistance level through here. I've got Goodman Group now trading at around about a 3.7% dividend yield. So it still remains fairly expensive relative to some of the other names, up at around 5%. But for good reason, Goodman's delivering a solid sort of 7-8% earnings growth per annum. GPT, so out of the other property plays, I think GPT back on a 5% dividend yield looks attractive here. I wouldn't want to see it sort of break below this support level too much. If we saw a breakdown to sort of 450, then I'd get concerned. I think it's cheap, but would probably be a bit of a dead cat bounce from that level. The only thing that's going to drive a further breakdown in these property trusts are the US Treasury yields ticking higher, which I spoke about earlier. And that just comes down to the commentary that's going to be delivered with the December Fed meeting, which we're assuming includes a rate rise. That outlook statement, I think, will probably help to dampen markets' viewers to concerns around how quickly rates rise. And I think in that context, we could see these property and infrastructure stocks bounce, either coming into the December meeting or just on the other side of it. Insurance Australia Group, from a yield perspective, at a 5% dividend yield, the stock looks attractive. The pattern's starting to get a little bit messy and choppy. The company is buying back, I think, maybe close to $300 million worth of shares at the moment, which is going to help to underpin the stock. I think maybe it can push a little bit higher up to sort of $5.75, maybe even as high as $6, but I think we'll probably take the opportunity to sell covered calls. Don't see it doing too much above that. James Hardie, so I like this name. I think it's pulled back sort of from higher levels. We own it from around the $20 level, and we'd sold the $22 calls. The company should deliver earnings growth somewhere around 15%, and I think that puts a stock on a yield of around about 3%. But with US interest rates still low, one of the standout parts of the US economy is the housing market, and I think James Hardie continues to benefit from that. So I see this as a pretty strong, high conviction sort of buy on the dip here at around $20. Lendlease performed very well as we expected, so we kind of didn't buy into the market's concern around unit settlements, and we've remained long Lendlease, and we're starting to see it break back out to the upside. Everything that I read about the earnings outlook for Lendlease supports the company delivering earnings growth of around 8 to 10%. Puts it on a 4.5% dividend yield. I think sort of this is one that can continue to recover from the recent sell-off that it had over the course of sort of late 2015 and early to mid 2016. Mirvac, not one of my favoured stock. I tend to skip over this more often than not, but I'll just highlight that it's pulled back from its highs, and we see it as a potential buy on the dip for clients that are looking for added exposure into that property sector, but again, not our preferred allocation. Medibank pulled back to reasonable valuation now, about 16 times earnings on a 4.5% dividend yield. We highlighted it as a buy on the dip down here, with expecting it to rally back to 250 to 260. At that price point, you want to be selling covered calls. Don't see it returning anytime soon back up to this $3 level. The earnings result in January, February might be a catalyst if the company does a bit better on the cost out story, where we could see it trade up to 275. But I think selling calls at around that 270 level seems like a fairly safe sort of play to me. Macquarie, I just see this back in fair valuation range. The company should deliver about $2.1 billion of earnings, place a stock on just under a 5% dividend yield, but don't expect it to do too much more than that. NAB, so the technical structure here is still predominantly lower lows, lower highs, which is why I've put in this sort of resistance level here around $29. That puts a stock on about a 6.5% dividend yield. So from a yield perspective, slightly more attractive than the other three names. But I do think that the banks struggle to grow earnings, so I'm not sure what the catalyst is to really drive it sort of through this resistance. And my base case is the banks, they predominantly move sideways. Newcrest, we're just seeing gold sort of pull back and create a similar structure. Again, if the US raises rates quicker and the US dollar strengthens, gold probably underperforms. If we get through the December meeting and the Fed appease the market with their commentary around sort of a slow, gradual increase in US rates, then we might see gold bounce off these levels. So I don't expect Newcrest to do anything for another sort of another 6 to 8 weeks, but that'll give it time to maybe put in a base there, so keep that on your watch list. Origin, I think, continues to recover in line with oil prices eventually trading sort of more within that $50 to $60 range, and there is still the opportunity for Origin to split off their natural gas assets from their retail energy, which may then open up opportunities for corporate sort of takeover on one or both of those divisions. So I think Origin, although it's a slow recovery, I think it will gradually start to grind up to sort of more that 650 target. Not doing there in Orica at the moment. Oil Search not doing there. Qantas, we had been on the short side of Qantas, and I'd spoken about covering those shorts and looking for Qantas to rally back. We're starting to see that happen. I think this rally actually could gather a reasonable amount of momentum and see Qantas sort of trade back through that resistance level. QBE is doing a little bit better off the back of rising yields in the US. Ramsay Healthcare not doing there at the moment. Rio, as I said, both BHP and Rio, about a 3% yield based on the increase in dividend over the next 12 to 18 months. Commodity prices have had a good rally. Data out of China was a little bit soft yesterday, which is what's helped to sort of create this short-term sell-off in BHP and Rio, but I think they sort of sit up close to these resistance levels, and maybe we're getting close to a point where you want to be selling covered calls to enhance the returns over them. Centre Group, so this is Australian Westfield, now trading back on a yield of around about 5%, 4.9%. I think, again, consolidates down here near the support level. The catalyst is probably not until we see an outcome for the December rate rise that we get any reversal in this downtrend. And I think a lot of these yield names will probably just consolidate over the next 6 weeks at or near that sort of the support level that they're beginning to establish. Seek starts to look okay. We like this name, higher highs, higher lows. Company should deliver about 10% underlying earnings growth. We own it, and we've sold covered calls over Seek in client portfolios. One of the few names that to me offers a little bit of growth opportunity for portfolios. Stockland, so structurally the stock looks okay, about 7-8% underlying earnings, 5.5% dividend yield. My thesis sort of on all these property names is that they consolidate at or near this level over the next 6 weeks, and again the catalyst becomes the December rate rise. Sonic Healthcare, I think this is a name that offers some upside potential for portfolios. I'd be owning it at these levels, looking for it to rally up to 23.50 over the next 6 to 12 months. So our strategy there is we own it at or near these levels. We've sold the covered calls up at sort of around 22.50, which is effectively delivering about 10% cash flow per annum, and we're also getting exposure to an eventual exit price that's above our purchase level. Not doing their incentives. Suncorp, flag at the moment from a technical point of view that it's created higher highs, look to be now putting in a reasonable base here at around 12.40. from an underlying earnings growth standpoint, Suncorp deliver maybe something at around 5%, puts the stock on a 6% dividend yield. From a technical standpoint, if we saw it break below $12, I think it becomes more concerning. Sydney Airport's now on a 5% dividend yield. You can see here that I've flagged, and it's probably just worth pausing on this as a point. So even though these yield names have the potential to have a bounce, it's worth highlighting that they've changed after spending quite a few years in a higher high, higher low structure. They're now breaking back down and creating a lower low, lower high. Although that doesn't rule out the chance over the next couple of years or the next, say, 6 months, the US yields don't rise and these names, continue on with their uptrend that they'd been in. But to me, that now becomes a lower probability, and the higher probability scenario is that the structure's broken. We find a support level, given that they're paying 5% dividend yield, delivering reasonable earnings growth. We get a rally back up at some point, maybe following the December rate rise, but eventually the market forms a view that maybe US rates continue to increase at a gradual pace. And that might be enough to cause a bounce, but ultimately probably won't favour them going on to make a new higher high. So for that reason, any rally back up to these levels, I think you want to be looking at selling covered calls. And the same applies here for Transurban. So I've just gone to provide some detail on that so you understand why I have sort of this sell and the question mark up at these levels, as I think that sort of puts the stocks back on roughly sort of 0.5% lower dividend yield than where they are at the moment, between 50 and 100 basis points lower, and I don't think there's the catalyst then to sort of drive them on to new highs. So I'd be looking at either locking in the profit or as a minimum selling at the money covered calls to enhance the returns from these utilities and infrastructure names that have performed well, but we're starting to see a change in the structure there. Telstra, I think the structure is actually negative here, but I thought everything the company said at the AGM was encouraging. They're spending further, I think something in the order of $3 billion to upgrade their network over the coming years. They recognise the issues that they've had with outages, and the commentary out of the company would suggest that the underlying business is going to continue to grow in single digits, so somewhere around 4 to 6%, and being on a dividend yield at the moment of around 6%, I think the stock should be able to trade back up to around $5.50. Treasury Wines, one of the standout earnings results. I think the company can deliver something around 15% earnings growth. And it certainly has the capability of trading up above sort of $12.50. I expected it to consolidate and move sideways for a while, but right at the moment, the actual price action is starting to look pretty strong again, and we may see that push up to around $12.50 when we get closer to the February earnings results coming through for Treasury Wines. Westpac, as with NAB, I think it's just pushing up against its resistance level, but don't see any major downside risk. Wesfarmers, we've had a substantial upgrade to earnings off the back of the improved coal prices. Underlying Coles and Bunnings, I don't think will be too different to last year. I have Wesfarmers now on about a 4.5% dividend yield. The company should pay out roughly around $2 of dividends, but the catalyst to drive this at the moment again is the turnaround in their coal or resource division, which weighed on earnings over the prior 12 months, and again with the rally that we've seen in coal prices, the market's starting to forecast dividend or earnings contribution coming through from that resource division in the order of something around $500 to $600 million. So quite a substantial turnaround considering it lost money 12 or 18 months ago. But at these levels, I think Wes is getting a little expensive, so we own it at lower levels. We've sold the covered calls. Don't see it pushing too much beyond that, but certainly if we saw a pullback to around $43, I'd be a buyer of Wesfarmers on the dip. Westfield, we like this name. It's on about a 3.75% dividend yield. But as with all these defensive yield names, we're seeing this change in structure where it's been in an uptrend. It's now broken lower. I think any rally back up will look for a lower high pattern to be put in place, and I think you'd want to be looking at rebalancing exposure to these names when that sort of lower high pattern forms over the coming months. Woolworths breaking out, but on a 3.5% forward dividend yield, it's hard to build a case that Woolworths is worth any more right at the moment than around sort of $25 maximum. So that's our view there on Woolworths. Again, when we see the earnings results in February, we'll get a better idea. But due to the price competitiveness within the grocery business, even though I think they've done a good job of winding down their Masters business, I think the underlying grocery business probably lucky to contribute sort of 5% earnings growth, and therefore again when you look at what the company's capable of paying out in dividends, it's hard to build a case that it trades above $25. Woodside Petroleum breaking out to the upside, higher highs, higher lows, in line with oil sort of trending high, and here we are back at the index. So just to summarise the view on portfolios, so we still have exposure to your defensive, whether it be property trusts or infrastructure. We've been aggressive. We're selling the covered calls, so we're making good money out of the dividends and the call option premium. We're mindful that the technical structure's broken down. We expect them to rally up, create a lower high, and then we look to sort of lighten the exposure in those names which have been good contributors to portfolios, and then start to have a look around elsewhere in the market for opportunities. At an index level, if we see this starting to sort of roll over and take out these lows, we become concerned. But if you sort of jump back to the view there on the Dow, what we're watching there is, can this US September quarter earnings build a base for S&P 500 stocks, or in this case the Dow 30, at around this sort of 18,000 level. If it can, then we continue to keep a long bias to portfolios. If we start to see it sort of break back down, we review that. Thank you for listening in. If you'd like to know more about the service, please contact me using the details on screen.